When you see what has happened throughout 2018, emerging markets have suffered as currencies have fallen and stock markets along with them. They have barely eased up all year, but suddenly many investors now believe that this is the time to put some money into it. Will emerging markets rocket higher, or will the dead cat bounce? You came here for the truth, so let me unveil that for you. Today we're going to look at emerging markets. I want to talk about the US markets as well. I'm going to talk about stock buybacks, a lot to cover. Let's begin by taking a look at this article out of CNBC. The great bull market is dead, and here's what's next according to Bank of America. The great bull market is over as economic growth becomes less certain, interest rates rise, that is the most important factor, and that becomes an overhang. That's according to the Bank of America Merrill Lynch. Hartnett advises investors to focus on inequality, innovation, and immortality that would benefit from pharma companies and technology disruptors, along with inflation plays. Interest rate hikes from the Fed and other central banks will have a significant impact growth that may not be anticipated in the markets. And that's the only part of truth to this whole article. But basically, that is a factor that is not priced into the markets at all. And this is what a lot of so-called investors do not understand, and that is markets price themselves in advance of an action. So for example, if they are going to increase interest rates, they're going to do so, let's just say it's going to happen in September. The market makes the assumption based on all these analysts and everything, okay, we're going to increase interest rates. It looks like that's what's going to happen. As a result, this is what we expect. And then the market adjusts accordingly, even if it hasn't happened already. And then by the time it does, you have little effect. It may still go in that direction, up or down, or however it's going to be impacted, but not to the degree as if everything is waiting for the moment. Will they do so or not? The market already prices it in advance. Okay, that's very crucial to understand. And that goes for interest rates, that goes for all different types of factors. Emerging market rout is the longest since 2008 as confidence cracks. This article is out of Bloomberg, and it says here, for stocks, it's 222 days, currencies, 155 days, for local government bonds, 240 days. Now, I believe this article was from earlier in the month, if I remember correctly, but regardless, it's leading me into another point. This year's rout in emerging markets has lasted so long that it's taken even the most ardent bears by surprise, and not one of the 7 biggest sell-offs since the financial crisis, including the so-called taper tantrum, inflicted such pain for so long on the developing world. And now we have a different situation happening. This chart and the following are out of Bloomberg. Bear retreat, short interest collapses in the biggest EM ETFs, emerging market ETFs here are seeing a huge change that is going on right now in US dollar terms. We are seeing that. You could see in the purple area there. That's Vanguard's emerging market ETF. Is the emerging market sell-off over? Fund C's biggest inflow in a year. So that is a very significant change that we are witnessing right now. Whether or not this is going to be able to be sustained for a long period of time, I don't know. But what is to be looked at is this really just the dead cat bounce? So for those who don't know what that is, basically it happened in 1929. It happens quite often, actually. If you look at the stock market, it's, let's say, just rising in this way here, and then the stock market comes down, and let's say that's 20%. Okay, so all of a sudden people are saying, wow, 20%, I can get my stocks for 20% off before they rise further. Great, I'll buy in. So the market then rises, but then it drops down even further. And that's the dead cat bounce. That's the technical indicator in the technical term. But essentially, could this be the case? We'll see. We're going to have to find out. This is very, very short term, so we're going to obviously track it over a more long-term basis. I will bring you those updates. Emerging market bond ETF gets the biggest inflow in more than a year, and you'll see that on the chart on the right-hand side in the red shaded area. Now, Alibabas Jack Ma backs down from promise to Trump to bring 1 million jobs to the US. So suddenly he turned around and said, well, that was based on the fact that everything was going to be fine between the two countries, but now that's breaking down. There's no way that this can happen. So I wanted to show you this because it's going to affect the markets. There are trade issues that are going on that we haven't seen in a very, very long time. And yet today, we are seeing this here escalating every day, it seems. The market does not price it in at all. The US market is completely unaffected by the trade issues. If it is, it's maybe for a half a day, and by the end of the day, everything's all fixed up again. Look at the difference. You could see the emerging markets versus the US, or specifically the S&P 500, that's been rocketing higher, whereas the MSCI World, so the world stocks, but just minus the US, and look at where it has gone this year so far. It has been brutally attacked, and we are not factoring it in, the possibility that maybe some of this trickles back into the US. No, the US is apparently impervious to all problems. Well, what we are seeing here, big time, is that companies have been buying back mass quantities of their own stock. Companies set to buy back $1 trillion worth of shares this year, and that should keep market afloat. That's according to Goldman Sachs, and they are right. When you buy back $1 trillion worth of shares, you basically send the message to the market that everything is okay. People, average individuals, do not know what's happening. They don't know what's going on behind the scenes. They just see that the stocks keep rising and then they keep buying in. It's not actual investors. It's not anything to do with selling cell phones, selling watches, selling products online. It's nothing to do with that at all. This has to do with shares being repurchased and central banks intervening in the markets. Once we start understanding that, we can actually understand what's really going on behind the scenes. Now, this is talking about Berkshire Hathaway, Warren Buffett, and I just want to show you cash equivalents, and I believe it's referring to treasuries, basically liquid investments here. In the last quarter alone, massive amounts of cash they are sitting on, and they are considering repurchasing shares at this time, if I remember the article. Quickly going to read it here. Warren Buffett explains the enduring power of stock buybacks for long-term investors. Warren Buffett, billionaire investor and chairman of CEO Berkshire, has long held belief that stock buybacks can often be the best use of corporate capital. He is such a big proponent of stock buybacks and was very, very happy that Apple has been buying back their stocks here, but doesn't believe it should be done on let's do it on a quarterly basis. Let's do it on a monthly basis. They are doing it in such a way they believe that as long as the stock makes sense to purchase. So for example, if you're going to profit more off of buying your own shares versus buying another company, for example, or keeping them in treasuries as they're doing today, well, maybe it's more beneficial to buy the stock. Well, they can do whatever they want. I think, though, it shows the fact that they don't have an opportunity to be buying into other companies right now, that they don't find anything really attractive. So they'd rather buy their own stock at this time. Now, there's a lot to do with that. It's not one-dimensional. I just thought it was really interesting how he was such a proponent. You can read the article here in the interview, how he's just speaking very, very highly of stock buybacks. And just a little interesting note, everybody always focuses on Warren Buffett and he always makes the news, but Charlie Munger is the one you really need to be focusing on if you want to understand anything about Berkshire, because Warren Buffett and Bill Gates both call the individual that works at Warren Buffett, his partner here, Charlie Munger, the smartest man in the world. So, if Warren Buffett's saying this, basically I would say the top three people, two of the top three people, richest people in the world are saying this guy's the smartest guy, then you should be really reading him. And the individual reads, if I remember correctly, I read something like 8 hours a day. So, these guys are insane in the amount of books that they're reading every day, and they're learning a lot, no doubt. I'm not suggesting that anything that they say is wrong, but remember that they are trying to manage a multi-billion-dollar company, and they can't necessarily say, well, you know what, stocks are looking really bad right now, because that looks bad on their business and they're going to get people selling off their stock. It's not a good thing to do that, clearly. So I'll end it there. If you found the video informative, please give me a thumbs up. When you give me a thumbs up, it helps to support the channel. And if you want the financial education you were not taught in school, you can get that in these 2 books. There are links in the description below. If you're more interested in the audiobook version, you can get that at themoneygps.com.